So we are going to dig into one of my favorite real estate stocks to cover, EPR Properties. Before we do, please check the link you see on your screen for a message from my sponsor, The Motley Fool. You can get the top 10 stocks to buy right now, and it's the best way to support this work we're doing. So EPR has been, like I said, it's one of my favorite real estate stocks to follow because it's been a very interesting company lately. It owns a lot of the properties that I like to go to, quite frankly. It has movie theaters, it has water parks, it has ski resorts. Tyler, I don't know if you're a skier, but I know you come from a place where people ski. Um,
Oh yeah. Oh yeah.
skiing's big where you're from, if I'm not mistaken. So they have Top Golf's their second largest tenant, and they are growing very very fast. They actually just filed a construction permit about 5 miles from where I'm sitting right now, which I'm excited about because I am not a skier, but I am a golfer, so I'm excited about that one. So it's an exciting company because it's the only real estate investment trust that is exclusively focused on experiential properties, properties that sell experiences, not physical products. Um, it's very levered to movie theaters. That's the bear case in a nutshell. Is that it's very levered to movie theaters. Its top three tenants are AMC Entertainment, Top Golf, and Regal Entertainment, and theaters make up roughly 40% of its rental income right now. So, Tyler, I know you dug into EPR quite a bit more recently. Are you more optimistic after digging in, or did this kind of bring up some more concerns?
I, I wouldn't say it brought up more concerns because I think the last time that you and I talked about this, it really seemed to be a story management was telling, and then there was a story the balance sheet was telling, and they kind of were going in opposite directions. EPR was talking about this growth profile that they wanted to build, but their their leverage and their debt had gotten so high that you didn't really see where it could do it, right? Uh, Fortunately, since that time, its debt position has gotten much better. Obviously, cinemas have been performing better lately, and so a lot of the previous lost rent rolls that were tied to cinemas and things like that have come back since the depths of COVID. Also, 2020 it wasn't just cinema problems. Basically, anything that was experiential real estate was suffering because people weren't going to go do things during pandemics, mostly because of lockdowns. So with that, the debt profile looks a lot better. The balance sheet looks a little bit better, and so you can see the signs that growth could start to happen, and some of those ambitious things that management was saying a while ago are starting to look like they're more feasible. Now, you and I talked offline. There's some. It's a little wonky with that because they have credit lines, but they can't really use them yet because debt isn't quite fully there. And so, you know, yes, it looks better, and hopefully we'll get to start to see some growth because one thing that you really start to notice with EPR properties is over the past 10 years, it's FFO per share, so funds from operations per share. I want to really emphasize the per share part is almost flat for the past 10 years. And if you're buying real estate, you do want to see that growth because FFO per share is where you're going to get your dividend from. And that's basically the most important part of what you're going to do when you're buying real estate. I know that EPR has a dividend yield of 7.7%, which, it doesn't have to do a lot of growth to be attractive at that high of a yield, but you still need some, right? Because otherwise, why not just go buy debt and clip coupons for no growth businesses? So yeah, it looks improving, but I really wanted to tap you because you follow the business parts of it a little bit more. I'm more following the financials. You follow the business a little bit more. Like, where is that growth going to come from that's going to allow us to see that FFO per share growth that would make the stock a little bit more attractive than, say, like I said, buying debt and clipping coupons?
Yeah, so there are a few things to note recently. Like you said, the balance sheet tells a different story when it comes to growth. They're not going to be able to use a ton of their untapped credit to the credit line to use to fund growth. It's not a great time to sell equity to raise capital right now. Um, I'd be it would make me rethink the stock if they decided to do that. Um, in the near term, I think growth is most likely to come from getting rid of some of its theaters and education properties. which it said it wants to reduce. The education properties, just the short version is experiential properties have better cap rates right now. So if it could sell the education properties and redeploy that into, say, new Topgolf facilities, it would likely get better cap rates than it's getting on its educational properties right now. So that's one. Uh, the Regal Entertainment, the third largest tenant, recently went through bankruptcy. It's emerged from bankruptcy. That's resolved. 11 theaters that were previously occupied by Regal, the company is not going to keep, and EPR is going to market those. So that should free up some more capital to deploy. It also has $100 million worth of cash on the balance sheet, which is a lot for a REIT to just keep around. So it has some money to fund growth opportunities right now. And it's also worth noting that the Regal lease that was just signed covers 41 theaters and has a big performance based component. So basically, it's structured that if box office revenue is exactly what's expected, the company is going to recapture, I think, 96% of its previous theater rent, and it has those 11 properties to sell. If the box office performs better than expected, it could actually get over 100% of its previous rent while still having those properties to sell. So a lot of investors don't like the fact that its performance is not only tied to the health of companies like AMC and Regal Entertainment for rental income, but the fact that it's tied to the performance of the overall box office, for a good bit of what potentially could be FFO growth going forward. Because this is it's written into the lease year after year after year, and if the movie theater business keeps growing, I mean, since the pandemic, obviously more people are going to movie theaters now than they were a year or 2 years ago. But theaters before the pandemic were doing a great job of increasing per guest spending through things like higher end food options, newer seats in the theaters. I know a bunch of the ones near me renovated their theaters before the pandemic. So if they can continue to drive per guest spending in their theaters and you know movie studios keep putting people in the seats, it could be a net positive for FFO growth. But that's a big if, and we're seeing that priced into the stock. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment, so I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by nearly 4 times. Go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 504% as of September 8th, 2023, and are measured against the S&P 500 returns of 130% as of September 8th, 2023.